So Canopy Growth is being added to the S&P TSX Composite Index on March 17th, and a lot of people are wondering what this means for the stock. So I did a bunch of research, went through a bunch of different articles. Some of these are quite long, by the way, so I didn't fully read through them, but looked at a bunch of different sources, saw what they had to say, and here's the summary. So apart from a stock, whenever a stock gets added to an index, it is going to be part of some funds, and those funds are good because they're going to be taking stock, putting it somewhere, and holding it for a long time. So that's good, but that's not a very significant portion of a stock. The bigger significance of a stock being added to an index is that the stock gains more exposure. And exposure is not really a guarantee of anything, but exposure does give the stock a certain multiplier effect. So let me give you an example. So if we have a small company, well, if we have a company, and let's say the company does really well in a quarter, let's say it gains 20%. If that same company had been part of an index and had much more exposure and much more news done about it, then those same good results might have been quantified because a lot more people would be looking at them and a lot more people would be hyping up the stock and buying it. That same company might get 30% increase in its stock just because it had a lot of exposure since it was part of an index. Now the same of course is opposite. The same of course is true in the reverse. So if a company does worse than it was expected to do and it is part of an index, then there's going to be a lot of news being published that the company did badly, and you might get overselling whereas otherwise the company would have not had as much overselling as it did. So it's kind of a double-edged sword, but a company being added to an index in itself doesn't actually mean anything. In the long term, it means absolutely nothing for the company, for the most part at least. There are exceptions, of course, but in itself, it doesn't actually mean a lot. A lot of it has to do with the company itself. So if you have a company that you expect to do really well in the future and it gets added to an index, well, that's really good for you because it means that if your prediction is correct and the company does do really well in the future, then the extra exposure that it gets from being inside of an index is going to cause the stock price to go up more than it otherwise would have. So it really depends on the company itself. It depends, the company is not going to do better just because it was added to the index. It might just get the results quantified that it would have had. So hopefully this helps, gives you a little bit of insight, and yeah, that's it.